So Apple's hit 52-week lows. So if you're a new investor looking to get into Apple, what does that mean? And if you're holding Apple currently, like I am, what does that mean? We're going to dive deep into Apple's numbers, figure out what they're doing right, what they're doing wrong, and figure out the intrinsic value of Apple so you should have an idea what you should be paying for this company today. So here's the thing with Apple, guys. We're going to load this up first onto just Yahoo Finance. This company over the last year has been performing fairly well. It's beaten earnings in the last 3 quarters, so Q1, Q2, Q3. However, the stock price is down by a large amount. Take a look at that. August, we've hit a high of 173. Now we're currently at $127, give or take, at the time of recording this video. So loading this up in the stock spec software, and you want to get your hands on this software, folks, follow the links in the description box below. 7-day free trial. And what this software does is an amazing screener tool to figure out the intrinsic values of companies along with other features that I'll go through in just a moment. Currently sitting at around $127 a share. It being on a downswing, it gets me a little bit excited. So we're ranking this company a 7 out of 10. Now what this software looks at, if you're new to the channel, is that it takes a look at the financial statements of the company, so it figures out if it's hitting certain metrics and basically awards it a point if it is and takes away a point if it isn't. So with Apple, we are ranking this company a 7 out of 10. That is a fairly solid score. So the things that they are doing wrong, before we get to the things that they are doing right, are simply this. Their 5-year price to earnings ratio on average has been 24.75. We like to find companies that have a PE ratio at 22.5 or lower. That is a somewhat more of a fairer multiple that we're trying to find, because you don't want to overpay for earnings unless it's a quick growing company, and in which case that deserves a deeper dive, because they might be able to justify that growth. With Apple, take a look at the trailing 12 months. Their price earnings ratio is 20.53. So it's not terrible. It's below that 22.5 threshold that we were looking for. Now, going further down the list here, current ratio is another metric I look at, where we like to find companies that have a current ratio of 1.5 or higher. Now, Apple's currently sitting at 0.88. Not the best. We want to find companies that have 1.5 or higher, because that would indicate to us that they have enough assets on hand to cover the liabilities. You would think that Apple, as large as they are, they would have a higher current ratio. Unfortunately, they don't. They've been taking on a lot of debt to fund their research, and why not? If it's cheap, if money was cheap with low interest rates, a lot of tech companies will take advantage of that. And that's evident here, folks. And last but not least, their debt to equity ratio sitting at 195%. Now, that would indicate to us that they're leveraging capital from debt and not through equity to fund their business operations. Not all is gloom, as we could see, right? It's only 3 things that are being knocked off, and one of them is pretty somewhat forgivable. 24.75 isn't the worst, and it's currently sitting at 20.53 for their price earnings ratio. They're doing a lot of things right. Their return on equity average is incredibly high, sitting at 110%. Where we want to find companies sitting at 15% or higher. Apple's well above that. Their EPS growth is up 515% increase over the last 5 years. They are buying back shares, which is great. We want to find companies buying back shares, or at the very least keeping the share count the same, and Apple's doing the better half of that. Their net income is up, so their free cash flow is up over the last 5 years, and the return on invested capital average is incredibly high, sitting at 38.94%, as well as the revenue growth is up 12% over the last 5 years. This is great. This is phenomenal to see with Apple, and rightfully so. Like, it is a massive company. Warren Buffett has a majority of his portfolio allocated to this business, and it's easy to see why. So for the dividend investors, something to keep in mind is, what is the company doing to keep your dividends safe? So right now with Apple, their yield is 0.84%, which allocates to being $14.8 billion of cash pretty much dispersed to the investors. What we want to find out, folks, is if that dividend is safe, and that is coming from the average free cash flow. You can take a look at that, or even the trailing 12 months that are coming in. Is that number higher than what's currently being paid out? If so, then you have nothing to worry about. If not, that's when you should be concerned. $14.8 billion easily can be paid out with the average of $80.2 billion that the current average brings in. And the free cash flow obviously being $111.44 billion easily covers that, no problem. They have a really high Piotrowski score sitting at 8, where we want to find companies that have a Piotrowski score between 7 and 9, 9 being the highest score you can achieve, so that's phenomenal. And their Allman Z score, a score that ranks if the company is in risk of bankruptcy. Between 1.8 and 3, It's in a gray zone above 3. That means the company is safe. Apple is currently sitting at 6.65, well above that threshold. So you have nothing to worry about in case you did have fears that Apple was at the risk of bankruptcy. They are nowhere near. So 7 out of 10 score on the financial valuations. Obviously, I like this company. I own this company. But the main question you're probably asking is, what should we be paying for this company? This company's stock price is down. Should we be concerned? And honestly, my answer is no. What we will do, though, we'll go to the price analysis section, and I'm going to fill out these lovely boxes here using the historic numbers that Apple has done over the past to try to guesstimate what they could potentially do in the future with some conservative estimates over a 10-year basis, and we'll figure out what we should be paying for Apple today. So if you're enjoying the video so far, hit that like button and subscribe button. Let's go over to the price analysis section and figure out what Apple is worth. I inputted some numbers into these boxes, staying conservative because that's the type of investor that I am. So I looked at what they've done over the last 10 years, and I've made some conservative estimates on the revenue growth because, look, this is a $2 trillion company. I can't assume it's going to be growing rapidly. Now, the average calculation comes out to be $122, where our current price is $127. It's very close. Now, if you agree with these aggressive numbers, 7% revenue growth over the next 10 years, profit margin being relatively where we currently are, free cash flow, same thing, and price to free cash flow being at 18. Like, this is pretty much, if the company stays the same on these metrics that we currently are at over the next 10 years with a 13% return, you can expect to be paying $149 for this company as fair value. So that metric would mean it's undervalued. However, for me, I think it's got to be between this conservative average and moderate average. That's where I really like to see companies. So 97, 121, call it $110. We're not too far off. We're not too far off. And honestly, as I expressed earlier on in the video, Apple has beaten their earnings over the last 3 quarters, and hopefully they'll be able to beat their earnings in January when it gets reported. But as it currently stands, what do I think about Apple? Phenomenal business. I own some shares. However, I want to buy more, but I want to buy it at the right price. And if you've been following the channel, thank you so much for your support. And folks, if you want to get your hands on this software, like I said, follow the links in the description box below. In 10 minutes, I figured out where my stance is on Apple. And that stance is great business. I want to own more of it, but I need the price to come down for it to make sense. Anyways, folks, that is the video. Thank you so much for watching. I will see you in the next one. Check out the links in the description box below. The stock spec software, it pays for itself, and I've only scratched the surface of what this software can do. And if you're still watching this video, we have 10 years of financial data. There is a chart section so you can figure out what this company is doing on a visual perspective, from the shares outstanding, their assets to liabilities, and much more. Definitely check it out, and I'll see you in the next video. Let me know what you thought about this analysis.